looking at the forward with a small iteration where you give an option instead of making it a mandatory event, right? So forwards are the building blocks of all these derivatives. So once you try to understand that, we can work from there. You try to see the differences as we go along in terms of how options, futures, swaps differ from your basic building block. So what do you mean by a forward? Forward is essentially simply an agreement to deliver something in the future. Right? To deliver meaning to buy or sell. To buy or sell something. Something is the underlying asset in the future at a given point in time at a pre-agreed price. At a pre-agreed price. Okay. That's simply a forward contract. So anything that we do where we agree to do something in the future on a certain date at a certain price, it's a forward contract. Okay. If I agree to buy your car from you, that's the example I typically use. If I agree to buy your car from you 3 months from today at a certain price, let's say 5 million, right? We have entered into a forward contract. And it's as simple as that. Me agreeing to buy the car from you 3 months from today at 5 million rupees, that is forward contract. In this forward contract, there are a few definitions that you would want to know. When I say we agree to buy the car from you, I agree to buy the car, you are agreeing to sell it. Okay? I have an obligation to buy the car 3 months from today, and you have an obligation to sell the car to me 3 months from today. Both sides in a forward contract has an obligation. Okay? Both sides have an obligation. I, as the person who agrees to buy the car, we call the person who agrees to buy the long side of the contract, the long part. And the person who agrees to sell is the short. Okay. So I agree to buy the car from you. I'm the long end of the contract. You are the short end because you agree to sell the car to me. The car in my contract is the underlying asset. It is what my contract derives value from. So the car is my underlying asset. And the contract will always have a set date and a set price. And the form of the contract between the two parties will always be an obligation. Will always be an obligation. I am obligated to buy the car from you 3 months from today at 5 million. And you are obligated to sell to me 3 months from today at 5 million rupees. Right? So a contract where one party has the obligation to buy or sell a certain asset from another party or to another party at a specified quantity, specified price, specified date. So we had specified date, specified price, specified quantity, one car. Okay. That says it. That's it. That's a forward contract. It's a very simple contract. It's an agreement between two parties, sometimes formalized, sometimes informal. If you're looking at the financial markets, then you look at a formalized contract, right? They are over the counter. Over the counter means they are customizable because you and I will agree on the terms and conditions. Forward contracts are not standardized contracts. They are customizable contracts, right? So you and I agree to buy the car in 3 months' time. It's a customized contract, right? It could be on the 20th of July that we agree to do the transaction. Or it could be on the 31st of August that we agree to do the transaction, right? We can customize the transaction any which way we want to. The agreed price, customizable, right? So It's a customized contract over the counter. It is not traded on an exchange, right? So forward contracts are not traded on an exchange. We also say forward contracts are zero-sum games, right? Zero-sum games, meaning if one party wins, if one party does better, the other party always loses, or the other party does worse. Compared to what? Compared to what could have been, what could have happened. I agree to buy the car from you 3 months from today at 5 million rupees, right? And you agree to sell to me. 3 months from today, if vehicle prices have crashed and the vehicle is available, the same car is available from somebody else in the market at 3 million rupees, right? I would have been better buying it from the other party at 3 million rupees, but I'm obligated to buy it from you. You, if you had not made that obligation to sell that car to me, you would have had to sell the car at 3 million rupees. Right? But because you have that obligation to sell the car to me, you are actually getting 5 million rupees. So you are up on the deal, I am down on the deal. Together on the whole deal, it's zero sum. You're up by the same amount, I'm down by. How am I down by? I could have bought the car at 3 million, but I had to pay you 5 million. There is an opportunity loss of 2 million. Same way for you, you could have sold the car at 3 million. You don't want to because you have now the opportunity to sell it to me at 5 million. You're up on the deal by 2 million. You would have had to sell the car at 3 million. But because you entered into this contract, you're selling the car at 5 million. Therefore, you're better off by 2 million. Okay. When I take the entire contract into consideration, I am down by 2 million. You're up by 2 million. Entire contract together, nobody is neither up or down. It's zero. Right? So forward contracts are zero-sum game. Always the gains or losses of one party is offset by the gains or losses of the other party. Right? Doesn't mean that offset doesn't mean that one party doesn't have an opportunity loss. They do. It's just that if you take the contract as a whole, it's equivalent. It's mirror opposites. Right? So why do you enter into forward contracts if you have the opportunity loss problem? Why would you enter into a forward contract when there is a probability that one party will always win and the other party will always lose? Because forward contracts provide price certainty. How did forward contracts come into play in the first place? They came into play because of agricultural products, right? For example, corn in the olden days, just like, here now, you will see the same phenomena happening with crops. If, for example, it's a good year, then what happens? If it's a really good year, there is a bumper harvest, but I have a lot of goods to sell. I, the farmer, have a lot of goods to sell, but everybody has a lot of goods to sell. Everybody has a lot of corn to sell. Market is flooded with corn, and I have to sell at lower prices, right? And vice versa, in a bad time, in a bad harvest, then what happens? Prices are skyrocketing, but I don't have corn to sell. Forward contracts provide price certainty. I know whether there is a bumper harvest or not, my corn will be sold at this price. Okay? So to get that price certainty, I give up on the opportunity that if there was no bumper harvest, right, and there was not a lot of corn that was available, then corn prices would shoot up and I could sell it for higher prices. I give up that opportunity to get price certainty. That's where forwards come into play. So that's how actually forwards have become popular a lot of the time with agricultural products, because you want to get price certainty on these agricultural products that were going to I mean, the crop was going to come in later, right? You're doing all this effort now, and the crop comes later, and you want to know that you will be able to sell your crop for a certain price, which is how forward contracts became more popular. So forward contracts, because they're OTC contracts, you can do them on anything. It can be like what we just discussed, a car, right? But generally, you would see forward contracts on currency, interest rates, commodities. These are typical, but you're not restricted. You can have forward contracts on anything that you want. Okay. And when you look at the end of the period, what happens? Now, let's say 3 months have gone by. At the end of the period, I am obligated to buy the car from you, whether the market prices are 3 million or whether the market prices are 7 million, right? If the market prices are 7 million, I'm better off because I've gotten into a contract with you to buy the car at 5 million. You're worse off because you've agreed to sell to me at 5 million, but you could have sold it in the market at 7 million. So there again, zero sum game. But you're obligated because of the forward contract to sell it to me. Okay. Excuse me. So, when the 3 month expires, what would happen? You would do the settlement based on, we can agree on how we want to settle, right? Now, if I want to buy a car, then obviously it would be what we call physical settlement. Physical settlement means you will deliver the underlying asset to me, which is the car. I will pay you. I will pay you money, right? I'll give you 5 million, and you will give me the car. That's called physical settlement. Sometimes what would happen is, without doing physical settlement, we get into a hypothetical contract where we say, let's cash settle. I don't want to sell this car to you. Car prices might maybe go up more, or for some other reason, they don't want to sell the car to me right now. They'll cash settle it. When they cash settle it, you settle the difference, right? So the losing party pays the winning party the difference. So meaning, for example, if car prices were 3 million and we had a deal to do for me to buy a car from you at 5 million, right? I'm worse off by 3 million, by 2 million. You're better off. You could have, if we did a physical delivery of the contract, you would have given me the car and gotten 5 million. And in the market, if I didn't enter into this contract, you would have had to sell it in the market for 3 million, right? But because of this contract, you got 5 million. If we cash settle, I would just give you 2 million without the car. What is the 2 million? The difference between the market price and the underlying assets price. Yeah. The pre-agreed price and the market price of the underlying asset. Pre-agreed price 5 million, market price is 3 million. I agreed to buy it from you at 5 million. In the market, I can buy it at 3 million. So I'll go and buy it from the market. I'm not going to buy it from you, but I'll cash settle you the 2 million. Okay. And on your side, you should be okay with that, because on your side, you can sell it in the market for 3 million, your car, you can sell it in the market for 3 million, but I've given you 2 million, but in the end, the car is really worth 5 million. You sold it for 5 million because I've given you 2 million. This is what we call cash settlement. Cash settlement. Okay. Any questions here? Any questions on forward contracts? So it's a very simple concept, right? Forward contracts it's a very simple concept. So if we quickly look, right, at another example, say on a currency forward contract, right? Let's say, for example, right now, let's say the exchange rate right now is 304, 305 rupees, right? That's the two-way, the buying rate and the selling rate. You're an importer. He wants to make a payment of 1 million rupees in 3 months' time. Not right now. His payment is due in 3 months' time. This is a hypothetical example, right? Just think of it in very simple terms. If he has to make a payment of $1 million in 3 months' time and he needs to buy these dollars from the market, at what rate would he buy it? How much rupees would he be paying to buy the dollars today?
$305.
305, yes. He'd be paying 305 to buy the dollars. So it would be costing him 305 million to buy the dollars today. Okay. But he doesn't need the dollars today. He needs the dollars in 3 months' time. So he can't buy the dollars and hold it. He doesn't want to buy the dollars and hold it. He wants to buy it in 3 months' time. Problem is, he doesn't know where the dollar will be in 3 months' time, where the rupee will be. Will the rupee be at 300, 299, 295? Or will the rupee be at 310, 315? Right? He doesn't know. So because of this, he can wait and find out. If the rupee depreciates, his cost becomes higher. Right? He has a problem in case the rupee depreciates. He has to buy $1 million from the market. His cost, instead of being a certain amount, right, whatever the amount, his cost would now be, let's say rupee depreciates 350. He would need 315 million rupees to buy $1 million. He doesn't have a problem if the rupee appreciates. If the rupee goes to 295, he doesn't have a problem because then he'll only need $295 million, million rupees to buy $1 million. So to get the price certainty, the importer can give up on that advantage that he will get if the rupee appreciates. If he thinks the probability of the rupee depreciating, for example, is higher than the probability of the rupee appreciating, he can definitely get into a forward contract where he goes to a bank and he agrees with the bank to buy dollars, for example, in 3 months' time, right? That's where so we are negotiating. Because it's over-the-counter transaction, we can customize the transaction exactly to the point of saying in 3 months' time on 20th of October or whatever, for example, right? So we can customize it and say, I will buy dollars from you at an exchange rate of 307. Right? So obviously, the bank is not going to give you the same exchange rate of 305. They will look at where the depreciation might be, and they will come up with a exchange rate that they feel is a fair exchange rate, right? They will make a assessment of an exchange rate that they will be comfortable doing the transaction at, right? So they'll say, okay, in 3 months' time, you can buy dollars from us, and I'll give you price certainty. You can buy dollars from us at 307. Now that's the forward contract. The importer has agreed to buy 1 million US dollars from the bank at a rate of 307 rupees per dollar. While the bank has agreed to sell $1 million, $1 million, while the bank has agreed to sell $1 million at 307 rupees in 3 months' time. What is the underlying asset of this contract? Sorry, I think you said dollars. That's correct, right? Dollars, US dollars, correct. So underlying asset of this contract is US dollars. I agree to buy, the bank agrees to sell. So who is the long party? Who is the short party? Yes, correct. So the importer is long because he agrees to buy dollars, and the bank is short because they agree to sell dollars at 307 rupees. This is the exercise price of the contract. We call this the exercise price of the contract, right? So this is the underlying asset, 1 million US dollars, where the importer is long, bank is short, and you agree, and the importer agrees to buy dollars at 307 rupees per dollar. That is what we call the exercise price of the contract, right? Now, you wait for 3 months. So this is the exercise date of the contract, 3 months from today, exercise date. Wait for 3 months. Now, we don't know what will happen in 3 months, but just in case, exchange rate was 300. Exchange rate was 300. Would the importer be better off? Who would be better off, the long or the short? If the exchange rate was 300. Who gets positive payoffs? Who gets negative payoffs? Who is better off?
Short party is better off.
Short is better off. Yes, short is better off. Because now dollar is 300, right? If the importer didn't enter into this contract at 307, he could have gone to the market and collected dollars at given 300 million rupees and got $1 million. But because of this contract, he has to pay 307 million rupees to get $1 million. Okay? So the importer is worse off. He's worse off by $7 million. The long party has a negative payoff of 7 million rupees, and the short party has a positive payoff of 7 million rupees. So, if this contract, and generally this contract will be physically settled, if it's a physical settlement contract, what would happen? The importer pays 307 million rupees to the bank, and the bank gives 1 million rupees to the importer. That's a physical transaction, physical trade. I give you money, you give me my underlying asset. I pay you 307 million rupees, you give me $1 million, right? That's the transaction. Just in case, and this is not usual for a currency contract, but it can happen, but not usual for a currency contract. If this contract was cash settled, then what would happen? Importer is worse off. How much is he worse off by? Negative 7 million, right? Bank is better off by positive 7 million. How will the cash settlement happen? Importer will pay the 7 million to the bank. Okay. He won't get $1 million. He won't get $1 million from this bank. He might go to another bank and get $1 million from another bank, right? So from the other bank, he might pay 300 million rupees. 300 rupees because right now the exchange rate is 300 rupees 3 months later. He'll pay 300 million rupees and buy the dollars. But his total cost is still 307 million rupees because he has paid 7 million rupees to this bank. Same way, for the bank, okay, they didn't make the sale of the dollars at 307 million rupees. They make the sale of the dollars at 300 million rupees. 300 million rupees, right? But they are better off because they got from this transaction another additional 7 million rupees, which brings their revenue to 307 per dollar. That's what we mean by cash settled. So currency contracts, you don't usually see cash settled. You see physical delivery. Same thing, other way around. If exchange rates depreciate, exchange rate goes to 310. Now the long is better off, the short is worse off, right? Because if the exchange rate goes to 310, the long is better off by 3 million rupees. He's buying dollars and paying 307 per dollar. If he didn't enter into this contract, he would have to pay 310 million per dollar, right? Or 310 rupees per dollar, or 310 million per $1 million, right? Now, because he entered into this contract, he's better off by 3 rupees per contract. 3 rupees per contract. But the bank is worse off. They could have, if they had these dollars, sold it in the open market to somebody else at 310, right? But now they have to sell it to me at 307. So the bank for every dollar is worse off by 3 rupees. So if it's physical delivery, it doesn't matter. You don't see it. It's just an opportunity cost where the bank will get 307 million rupees and pay the importer 1 million rupees. However, if it is cash settled, then the bank has to pay importer 3 million rupees. The other dollars don't get exchanged. It's simply the difference gets exchanged. Any questions? So that's the basics, right? That's a forward contract. I said the forwards are the building blocks for everything else. Forwards, futures, options, swaps. So we will move to futures. Futures actually are exactly forward contracts. There's nothing different. It is exactly a forward contract. Except futures are traded on an exchange, organized exchange. Forwards are not. Forwards are customizable over-the-counter contracts. You and I, me and another friend of mine, me and a bank, like as long as there is the underlying asset and they have the ability to pay the money or take the money and give the underlying asset, I can do it with anybody. Futures contract like heart, they're standardized, right? I have to go through an organized exchange. So futures exchanges, for example, like the Chicago Mercantile Exchange, Chicago Board of Trade, New York Mercantile Exchange, right? These are some examples of derivatives boards that will have certain futures contracts, for example, right? So here, all these contracts are what we call standardized contracts. You can't do a futures contract on something completely exotic, even a car. You and I can't get into a contract where we are trading that on the organized exchange. But you have futures contracts for so many things, you wouldn't believe it. So, like, for example, you have futures contracts for copper, gold, palladium, platinum, silver, crude oil, gas, natural gas, corn, soybeans, oats, rice, wheat, cattle, lumber, milk, coffee, sugar, even treasury bills and bonds, even different types of currencies. You have futures for a lot of different options. But all of these futures trade on an exchange. For example, the currency futures trade on the Chicago Mercantile Exchange. You can see here CME. CME stands for Chicago Mercantile Exchange. Chicago Board of Trade, CBT. Intercontinental Exchange, ICE. Intercontinental Exchange. New York Mercantile Exchange, I think. So you can see here different types of exchanges, right? Then Futures contracts are standardized. Standardized means you have to trade in quantities defined by the exchanges, right? You can't trade, for example, you have a copper contract, you can't trade 1 pound of copper or 20 pounds of copper, or let's talk in gold, right? You have a gold contract. You can't buy 2 pounds of gold or 2 ounces of gold. If you want to do a trade in gold contract, you have to buy a minimum of one contract is a minimum of 100 ounces of gold. Right? That's one contract. So palladium, 50 ounces of palladium. Gas contracts are minimum 42,000 gallons of gas. One contract is 42,000 gallons of gas. You can't trade 1.5 contracts. You had to trade one contracts, two contracts for 2,000 gallons of gas per contract, right? Wheat, 5,000 bushels per contract. Milk, 200,000 pounds of milk per contract. 100,000 AUD per contract. 200,000 face value per contract on the 2-year treasury notes. Okay. These are defined standardized contracts, right? So like even when you trade in the Colombo Stock Exchange, you have different standardizations, right? You can't buy decimals of shares, one shares, two shares, three shares, right? And then if the share price also, you have tick marks. For example, if the share price is less than 100 rupees, your tick size is 10 cents. So your share price will move in every 10 cents from 100 to 100.1, from 50 to 50.10, 50.20, 50.30, right? 50 rupees 30 cents, 50 rupees 40 cents, so on. But if it's above 100 rupees, your minimum tick size becomes 25 cents, right? So from 100 rupees to 100.25, 100.5, 100.75, it doesn't have 100.8. 100 rupees 80 cents is not available in Sri Lanka, right? Just like that, it's standardized. So that's what we mean. That's the difference in a futures contract. Futures contracts are forward contracts that are exchange traded, formal, standardized forward contracts that are exchange traded. They are standardized. They are exchange traded. Because of this, they have liquidity. And that liquidity gives you the ability to get into a futures transaction and get out of a futures transaction. Now, in a forward contract, it's a little bit more difficult. When I get into a forward contract, I get into an agreement with you to buy something or sell something. And I get into an agreement with you to buy a car in 3 months' time. I can't back out. If I wanted to terminate the contract, I'll have to find somebody else to buy the car from you. Okay. But there is no ready market for me. I don't know. I don't want the car. My friends don't want the car. Then who else do I find? Right. So it becomes a problem. But in a futures contract, you provide liquidity. But for that liquidity, you give up the customization and you come into standardized contracts. You still have the long positions, you still have the short positions, right? Long is the party who buys the underlying asset, short is the party who sells the underlying asset. Every day, these contracts get marked to market. We'll talk about that tomorrow. These contracts get marked to market. Don't worry about it now. And how these contracts trade on an exchange is through what we call a clearing house. It's through a clearing house. Now, what happens there is the clearing house guarantees performance of the contract, meaning it doesn't let you default, right? A clearing house is the in-between party that will be established that the long positions and short positions, everybody will do a transaction with the clearing house. If we didn't have, like in a forward contract, right? In a forward contract, there is no clearing house. The transaction is between you and me. I agree to buy the car from you. You agree to sell the car to me, right? The transaction is between you and me. You don't know if I'll pay. You give me the car, and what if I don't pay? There is a performance risk there, right? There is a default risk there that you might give me the underlying asset at the end of the period and find that because you had, I don't pay you at the beginning of the period. Always the payment comes at the end of the period, at the time of the transfer, right? And at the time of the transfer, after I get the vehicle, will I pay you? Or the other way around, after I give you the money, will you give me the vehicle? Who's going to guarantee that performance? There's nobody taking responsibility for that default risk. And especially in a market where I'm dealing with multiple parties, I don't know who I'm dealing with. I'm just looking at a screen, looking at numbers who are saying these people are willing to sell, these people are willing to buy, and these futures prices are available because it's on an exchange. And I'm saying, okay, this looks like the price I want to sell at, or I want to buy it in the future. I'll do this transaction. And I'm dealing with some unknown person who might default. That is the big problem actually in Sri Lanka stock market today as well. Forget about having derivatives, right? Which is why even in Sri Lanka stock market, we have seen we are looking to implement a central counterparty clearing system. The central counterparty clearing, right? This CCP system will be what guarantees that payment. Right now, brokers take on a lot of responsibility for the payment cycle to make sure that the payment cycle is normalized and there are no defaults. In case there is default, the brokers are the ones who take responsibility in terms of making sure that the money transfers are happening. But when a central clearinghouse comes, the central clearinghouse will be the one who's guaranteeing that performance. So the advantage of a futures contract also is that there is that in-between party central clearinghouse. And that's one of the reasons that Sri Lanka, we still can't do a lot of these derivatives because we still haven't implemented the CCP system. Okay? And once the CCP system comes, what will happen? The short will always trade with the CCP and the long will always trade with the CCP. The CCP will be the short for the long and will be the long for the short, right? So who faces the short party? The CCP. So the short gets into an agreement with the CCP to sell something. The short gets into an agreement with the CCP to sell the underlying asset. And the long gets into an agreement with the CCP to buy the underlying asset. On the CCP side, he's neutral. The long and the short will cancel itself off. But the long and the short never meet. They never meet. They don't know who they are, who each other is, right? Just like in stocks today. But here in stocks today, although we use these convoluted methods to guarantee performance, there is a risk in a market, right? And with high volatility instruments, the risk is much higher, which is where what derivatives are. So when you have the central counterparty, always there's somebody in between. So who is the front-facing guy between the long and the short? The long faces the clearinghouse and the short faces the clearinghouse. And that's how the transaction happens. So the long agrees to buy from the clearinghouse and the short agrees to sell to the clearinghouse. And the clearinghouse agrees to sell to the long and buy from the short. And that's how the transaction will happen. Any questions? So you reduce counterparty risk by having this clearinghouse in between. Okay. Shall we try this?
Yes, madam. That clearinghouse is run by the Security Exchange Commission. No, that kind of regulatory authority or how it is regulated?
The clearinghouse.
Yes.
The clearinghouse will have to get some sort of approval, in the sense they will be authorized by the regulator, like the SEC, to act as a clearinghouse. So to get that authorization, they will have to have the systems and processes in play. The clearinghouse will be run by an exchange, like the CSC, for example.
Noted. Thank you.
Try this question. Sorry, go ahead.
Yeah. Are futures cash settled or physically settled?
So that depends on the contract. Some contracts are cash settled, while some contracts are physically settled. A lot of I believe the interest rate futures and currency futures are cash settled contracts, versus some of the agricultural futures I have heard are physical settlement contracts. So what you need to do here is draw what your long party for your long party and for your short party. What we call this the payoff diagram. The payoff diagram. What would their payoff look like against the price of the underlying asset at the time of expiry of the contract, at the time the contract expires? So the first one asks you to draw the payoff diagram for the long party, and the second part asks you how would your answer change. So you have to draw the payoff for the short part. So we call these payoff diagrams or profit diagrams. For a futures contract, payoff diagrams and profit diagrams look the same. This is different for a options contract, right? When in options contracts, payoff diagrams and profit diagrams are different to each other. But in a futures contract, there is nothing. I will define the difference between payoff and profit when we come to options, because there you actually have a difference. But under futures, there's no difference between payoff and profit. what is the payoff or profit? This is the opportunity cost or opportunity gain that you have because you entered into the futures contract. The opportunity cost or opportunity gain that you have because you entered into the futures contract. Now, for example, you have this party A who has gotten into a long position. Oil. What does that mean? What does it mean when you say the party A has gotten into a long position for oil? Perfect. Yes. So party A is obligated to buy oil at $80 a barrel in December, right? That's what we mean by him entering into a long position. He's agreeing to buy oil in the future in December at $80 a barrel. Okay. You can just say today is July. Because it's out of context when you look at this example later on. You can say today is July 24. So now, once you come to December at expiry of the contract, right? When you come to December, now in this contract, party A is a long party. Exercise price is $80. We call that the exercise price. That means the price that he agrees to do the contract at. And this is the exercise date, December, right? The expiry of the contract. So in December, when he comes to December, actual oil prices can be a variety of things. I've only given you 3 scenarios, 70, 80, or 90. Okay. From these scenarios, we will extrapolate to figure out how it will look in the other scenarios, right? But if we look at 70, 80, or 90, oil prices being 70, 80, or 90 in December, right? If oil prices are 80, are you better off or worse off because you did the contract? Party A, the long. Are you better off or worse off because of this contract? Today is July. Now we are in December. Now the contract. So this diagram we draw thinking of what can happen in December at the time the contract expires. What can happen in December at the time the contract expires? So in December, if the oil price is $80 a barrel, you, the party A, are you better off or worse off?
Not both. It is
Absolutely. You're neither better off nor worse off, right? Your payoff, or you have neither lost nor gained. Your payoff is zero. Because market prices are 80, you've gotten into a contract at 80, you're agnostic. It doesn't matter to you whether you bought it from the market or whether you buy it from this person you've gotten into the contract with. So you don't care. So you are, for you, the payoff is zero. There's no profit nor loss. So at 80, for the long, there is no profit nor loss. The payoff is zero. But at 90, is he better off or worse off? The long.
better off.
He's better off. Why is he better off?
Since if we didn't have the agreement, we have to pay 90. Due to the agreement, we only pay 80.
Absolutely. Yes. If the long didn't get, if party A didn't get into this agreement, he would have to buy oil at 90 rupees a barrel. But because of this agreement, he buys oil at 80 rupees a barrel. That means he's better off by 10 rupees per barrel. That's what we call the payoff, the difference between the market price at the time the contract expires and the exercise price, right? So he's better off by $10. He's better off by $10. At 70, at 70, better off or worse off?
Worse off. No? Worse off.
Worse off. Because if he didn't get into the contract, he can buy oil from the market at 70, but because of this contract, he has to pay 80 rupees, $80 to buy oil. So he's worse off. Okay. He's worse off by $10. That's a negative payoff for him. Excuse me. So he's worse off by $10. If I look at what this graph looks like, I hope I can draw a straight line. Something like that, right? For the long party, the higher the market prices at expiry, the more better off he is, the more positive the payoff. And lower the prices, the more worse off he is, the more negative the payoff. So always for a long party, the payoff diagram looks like that. Looks like that. Okay. What is this point? This is the point of the exercise price. As long as the market price at the time the contract expires, is equal to the exercise price, always the payoff will be zero. But if the market price is higher, the long is better off. If the market price comes down, the long actually made a wrong call, is worse off. So how will the short look like? How would your answer change for the short position? Short is the other guy. Who is the short in this transaction? What happens there? Yes, exactly. The short in this transaction is the person who's obliged to sell oil at $80 to A in December, right? Today is July. The short gets into an agreement to sell oil to A at $80 in December. Okay. What does his scenarios look like? His payoffs look like when oil prices might be 70, 80, or 90 in December. What would his scenarios look like? Yep. Good. Go ahead. Say that again. Yes, sure. Yeah. So it is a mirror image of the long's payoff, because when at $80 anyway, nobody cares, right? The short nor the long doesn't care. Whereas the short is obligated to sell oil at 80. In the market, it's also 80. So for him, it doesn't matter that he has this contract or not. So the payoff is zero. But when oil prices are 90, He could have sold it if he didn't get into this contract. He could have sold it at 90. So because of that, he's actually losing because he got into this contract. He has an opportunity loss. It's not actual losses, it's an opportunity loss. And that opportunity loss of $10 because he got into this contract, right? Versus, so higher the prices, what will happen? His loss keeps on growing. Versus, when the prices are 70, he actually has opportunity gain because he got into this contract. He's better off by $10. He can sell it to me, to A at 80, when in the market he would have had to sell it at 70. Okay. So he's better off by $10. So the shorts diagram looks a little bit like that. Always the short will look like that, where this is the exercise price and this is the price at expiry. If I superimpose these two on each other, if I superimpose these two on each other, you can see this is the long. This is the longs diagram. And this is the shorts diagram. And one with the other will cancel out, right? So ultimately, the net effect will be 0. For the entire contract, the net effect will be 0, which is why we call it a zero sum. Okay. So that's what we were talking about. The exercise price or the futures price. In this scenario, we can call it the exercise price or the futures price versus the market price at the time of expiry. Market price at the time of expiry. So let's leave it at that. And we'll go on to sums tomorrow. Okay. Sorry about this morning. It was a technical error, so hopefully we won't have that tomorrow. Thank you.
Thank you.
Thank you.
Thank you.
Yes.
Thank you.
Thank you. Right.